Let's go ahead and run through the solution to example 4.8 from module 4, which has a relatively complex differential with another issue thrown in. Again, here's a summary of the example. We have that on January 1st, 2020, Big buys 100% of Little's common stock for $500,000. Little's book value on that date is $350,000, and we have a bunch of misvalued or unreported assets and or liabilities. We also have some information on income for the 2 years, 2020 and 2021, and to make life simple, Little pays no dividends. At the end of the first year, there's a goodwill impairment charge we need to take, and in the second year, we've got this contingent asset at acquisition. Little, the company we acquired, was plaintiff in a lawsuit, and they expected a settlement of $15,000, and in 2021, that settlement was made, and Little received a $15,000 judgment. Our job is to go ahead and go through the differential analysis and do the elimination entries and equity method entries for 2020 and 2021. So let's go ahead and start with our differential analysis. Fair value of the subsidiary less its book value gives us a differential of $150,000, and again, we need to explain why Little is worth $150,000 more than book value. First, there is some undervalued land. Now again, since the land is undervalued, that means that the land is worth more than book value, which means Little is worth more than book value, so that explains away part of that excess price we paid. So we're going to go ahead and subtract that out. Similarly with the in-process R&D. Apparently this in-process R&D is appraised to have a value of $30,000. That is not reflected on the balance sheet, but it is one of the reasons we bought Little, one of the reasons we paid the price we did. So that again, that explains away part of that excess price we paid. And that in-process R&D is expected to have a 2-year life, so it's going to be amortized at $15,000 per year. In contrast, they have some overvalued inventory, which we are going to add. Again, we subtract undervalued assets, we add overvalued assets. We've got some undervalued equipment that we need to subtract. That's going to be amortized over 10 years at $5,000 per year. We have some undervalued bonds payable. Again, if we subtract an undervalued asset, that means we would add an undervalued liability. So that $10,000 additional bond value is going to be amortized over 5 years at $2,000 per year. Finally, we have this contingent receivable. Again, Little, the company we acquired, is plaintiff in a lawsuit. They expect to be successful in the lawsuit, and they expect to receive $15,000. When we bought Little, we took that into account in determining what sort of price we would pay. So that explains away part of that excess payment. So adding all that good stuff up, we find that there's $55,000 left unexplained, and that must be our goodwill. Okay, so let's go ahead and go through our equity method entries. First, we acquire our investment. That's easy enough. Next, we report our share, 100%, of Little's reported income of $50,000. Once we do that, now we need to go through and amortize all of these various finite-lived intangibles. So let's just go down the list of those differential items above. First, we have the undervalued land. Land has an indefinite life. Land is never, ever, ever amortized. So that's going to sit there indefinitely. We do have to deal with the in-process R&D amortization, though. Again, this $30,000 of value was expected to be consumed or used up or realized over 2 years. And so we're going to expense that at $15,000 per year over 2 years. Now, with these amortization charges, sometimes it can get confusing. Do I debit or do I credit investment income? If you look up at that differential analysis, we see that in-process R&D was subtracted $30,000. So when that gets amortized, an easy way to remember this is that when that gets amortized, it's going to be subtracted from investment income. So we're going to go ahead and debit investment income for $15,000 and credit the investment in Little. Similarly with the inventory amortization, again, that was added with a credit, that was added up in the differential analysis, so that's going to be added to our investment income. Again, that's simply a simple mechanical way to view this. If you wanted to talk your way through this, you'd say, well, At the beginning of their year, their inventory was overvalued, which means that Little was over-reporting their inventory. When it was sold, they were over-reporting their cost of goods sold, which means they were under-reporting their income, which means that we under-reported our investment income. So what we're doing here by crediting investment income is correcting that understatement of investment income. The undervalued equipment, we're going to take $5,000 of amortization, and again, that was subtracted in the differential analysis, so that's going to be subtracted from investment income with a debit. We have the amortization of our bond differential, and finally we have our goodwill impairment. Recall that the problem assumed that at the end of the first year the goodwill needed to be impaired down to $40,000. It was initially $55,000, so we have to go ahead and write that down by $15,000. That's going to reduce our investment asset because part of that asset no longer exists, and we need to record that as a reduction of our investment income. Okay, going on to our elimination entries. First, we eliminate the subsidiaries' beginning of period owner's equity accounts. Again, those were common stock $50,000, retained earnings $300,000. Now we need to go ahead and record all of these various differential assets. So let's just go in order. First, land was undervalued by $20,000, so we're going to go ahead and write up Little's land by $20,000. Likewise, Little has this in-process R&D, which is not reflected on their balance sheet as an asset. From our perspective, this asset exists, and it's what we paid for when we acquired Little. So we're going to go ahead and add that to our balance sheet. We're going to go ahead and reduce the inventory to its correct value. Again, inventory is overvalued, so we have to reduce it with a credit. We have to add to the equipment account because the equipment is undervalued by $50,000. The bonds are undervalued, so if the bonds are worth more than face value, that implies there should be a premium on those bonds payable. And we also have this contingent receivable. Again, normally we don't recognize contingent gains or contingent assets. In this case, though, we actually bought this contingent asset. Anyway, we're going to go and record this contingent receivable, and finally we need to record the $55,000 in goodwill. Now, if you add up all of those debits and all of those credits, they tally up to a net $500,000 debit. This is a wholly owned subsidiary, so the entire $500,000 is going to be closed against the investment in Little. Now we need to do our various amortization charges. And again, let's just go ahead and go down in order through that differential analysis. The first differential item was the land, and again, I can't stress often enough, land is never, never, never amortized, but we do have to amortize part of that in-process R&D. In the elimination entry, we created the in-process R&D account, and now we're writing it off. Likewise with the inventory. As I said earlier, Little's inventory was overvalued. So from our perspective, their inventory was overvalued, which means their cost of goods sold was overvalued. So what we're going to do here is we're going to go ahead and reduce their reported cost of goods sold by $10,000. Basically, in that first elimination entry, we created the inventory differential with a $10,000 credit. Now we're writing it off with a $10,000 debit to inventory. Next, the amortization of that equipment differential. $50,000 spread over 10 years at $5,000 per year. Again, if you wanted to sort of talk your way through this logically, you'd say Little's inventory is worth more than book value, so they're not reporting a big enough asset, which means they're not reporting enough depreciation expense, so we're going to go ahead and adjust their depreciation expense upwards to reflect what we feel is the correct value. We go ahead and amortize part of that bond premium, and as we all know, amortizing a bond premium reduces our interest expense. And then finally, we take that impairment loss. Again, in the first elimination entry, we created $55,000 of goodwill, which we now realize needs to be written down by $15,000. Finally, our I for investment income entry. If you go back and look at your equity method entries and add up all the debits and credits to investment income, you should find that they add up to $27,000. Okay, let's go ahead and go on to 2021. And again, starting with our equity method entries. If you recall, in 2021, Little reports income of $60,000. Since Big owns all of Little, they report the entire $60,000 as their investment income. Now we need to start going through the amortization again. Again, just going straight down that list of differential items. Again, the land never gets amortized. The in-process R&D, we're taking the second of 2 years at $15,000 per year. The inventory is gone. The inventory was amortized last year in 2020, so we don't, we amortize that once and done, it's all gone, never to be seen again. We do need to take another year's worth of amortization on the equipment, and we do need to take another year's worth of amortization on the bond. Now we come to something that's a little unusual, the collection of that lawsuit settlement. Again, the assumption was that Little expected to have a judgment in their favor of $15,000, and in 2021 that actually happened. Now think about what Little would have done when they received that $15,000. Again, Little would not have recorded a contingent gain, so when that lawsuit was settled, they would have debited cash. They received $15,000, and they would have credited, gain on lawsuit or something to that effect. It would have been $15,000 of income on Little's income statement. Now again, from Big's perspective, they recorded that $15,000 prospective settlement as an asset. So at this point, all Big is doing is that, from Big's perspective, they're recovering that $15,000 asset they've already recorded. From Big's perspective, that $15,000 gain on lawsuit shouldn't be there. So that $15,000 gain is included in Little's reported earnings of $60,000, which means it's therefore reported in Big's investment income of $60,000. From Big's perspective, that shouldn't be there. So they're going to go ahead and reduce that investment income to strip out that gain that from their perspective shouldn't be there, and they're going to credit the investment in Little because, hey, that $15,000 receivable no longer exists. Okay, finally for our elimination entries in the final year. Again, we're going to go ahead and eliminate the subsidiaries' beginning of year owner's equity accounts. Common stock is still $50,000. Retained earnings is now up to $350,000. And now we need to carry forward the remaining differential assets. Just going through one by one. The land is still there at $20,000. At the beginning of the year, the in-process R&D was still $15,000. Again, it was created at $30,000. We amortized $15,000 in 2020, so we're carrying forward $15,000 to 2021. The inventory is gone, so we just blow past that. The equipment, we're carrying forward $45,000. Again, we created $50,000, we amortized $5,000 last year, so we're carrying forward $45,000. Same thing with the premium on bonds. We created $10,000 initially, we amortized $2,000, so we're carrying forward $8,000. We're carrying forward that contingent receivable as of the beginning of 2021. And finally, we're carrying forward the remaining unimpaired goodwill of $40,000. You add all that good stuff up, and it comes up to $527,000. This is a wholly owned subsidiary, so the entire $527,000 all gets closed against the investment in Little. Now we do our A for amortization entries. We take our second and final year of R&D amortization. We take another year's worth of depreciation expense. We take another year's worth of bond premium amortization. And again, we need to go ahead and adjust for that lawsuit gain and the collection of that contingent receivable. On Little's income statement, they're going to have this lawsuit gain of $15,000. From a consolidated standpoint, that lawsuit gain should not be reported because, again, from a consolidated standpoint, when Big Company bought Little, they bought that receivable. So all they're doing is they're collecting that receivable. So we're going to go ahead and eliminate the lawsuit gain and get rid of that contingent receivable that we created in that first elimination entry. There's just the narrative of, and by the way, if the lawsuit had been settled for more or less than the expected amount of $15,000, the excess or deficiency would have been recorded as a gain or a loss. So let's say the lawsuit was settled for $20,000. In that case, from Big's perspective, there would be a $5,000 gain. They were expecting $15,000 and they had accrued a receivable for $15,000. If they actually collected $20,000, that extra $5,000 would be a gain. So it would be the exact same entry. We would go ahead and debit the lawsuit gain for $15,000 to get rid of the expected portion. The remainder of that $20,000 gain that Little is reporting, $5,000, would still be reported on the consolidated income statement. And finally, we close out our investment income, $27,000, again, simply a coincidence that it's the same number as last time.